Okay, see here girls, one more illustration for the same type of adjustments. This is illustration 5353 in my textbook. Please locate this coinciding illustration number in your textbook. Even if you don't find, just focus here. A and B share profits of a business in the ratio of 5:3. They admit C into the business for 1/4 share in profits to be contributed equally by A and B. Marking line is equally by A and B. So sacrifice by A and B is equal, 1:1. On the date of admission of C, the balance sheet of the firm is as given. This is the balance sheet given to us. The capital A's capital, B's capital, worksman compensation fund, creditors fund, all these things have been given. Machinery, furniture, stock, debtors, bank, these things have been given to us. Further they say, after that, what is mentioned is the terms of admission are that C will bring rupees 30,000 for his share of capital and goodwill. C will bring 30,000 in cash. Remember the entry? Bank to premium for goodwill, and that premium for goodwill will be distributed to the old partners in the sacrifice ratio. That was the accounting treatment that we had discussed. Proceeding, the next adjustment on his arrival states, goodwill of the firm has been valued at 3 years purchase of the average profits of last 4 years. 3 years purchase, last 4 years profits, and the average profit of the last 4 years have been calculated and given to us, while the normal profits that can be earned with the capital employed are rupees 12,000. Average profit, normal profit. We can find out the super profit out of this, what we have earned, what normally business earns. So what is the extra profit, the super profit? We can find out the super profit, and super profit into 3 years purchase will be the firm's goodwill. Next, furniture is undervalued by rupees 12,000. That means furniture has to be overvalued now. It is undervalued. So increase the value of furniture. Increase in furniture, you know which side? By rupees 12,000. And the value of stock is reduced. Asset gets reduced, debit side. Provident fund be raised. Liability is getting increased. You know which side liability increases? Liability increases on the debit. Creditors are unrecorded to the extent of 6,000. Liability, unrecorded liability, increase in liability, debit. After this, we have been asked to prepare the revaluation account, partners capital account, and the balance sheet. So with the given adjustments, we prepare the revaluation account. The furniture has increased, stock has decreased, decrease in stock on this side, increase in furniture on this side. The provident fund liability increases on this side, creditors increase on this side, and the difference between both the sides is distributed among A and B, the old partners, in old ratio. And this is discussed, this is done. Old ratio is 5:3. That has been given to us. We have distributed that. Now let us calculate the goodwill. The calculation of goodwill, super profit, average profits have been given to us, normal profits have been given to us. So our profit minus the industrial profit is rupees 8,000. 8,000 into 3 years purchase, 24,000 is the value of goodwill, firm's value of goodwill. Now they say C brings his share of goodwill in cash. Very clearly it has been stated, C brings his share of goodwill in cash. Therefore, he brings in rupees 24,000 into 1/4. 1/4 share. 24,000 the firm's goodwill. He gets 1/4 share. 1/4 share means 24,000 into 1/4, that is 6,000 for his share of goodwill, which is included in the total amount of rupees 30,000 brought by him. Very clearly it has been given in the question. The amount of rupees 6,000 now will be distributed equally between A and B. Equally, why? Because equal is the sacrifice ratio. This is, they contribute equally towards the new partner's arrival. So 1:1 is the sacrifice ratio. Because they have sacrificed, in equal proportions. So after this, now we prepare the capital accounts. We begin capital accounts always with the balance brought down, A, B, worksman compensation fund, the funds distributed in the old ratio, revaluation account, revaluation profit this side in the old ratio, bank, this is the cash that is brought in by the new partner, by premium for goodwill, this is premium for goodwill in sacrifice ratio, this is at 6,000. That 6,000 we had 24,000 ka 1/4, 6,000, that's 6,000 into 1:1, that is 3,000 by him and 3,000 to him. This is C is bringing 24,000. His value of goodwill is distributed between A and B in the sacrifice ratio, that is 1:1. And this is the balance carried down, nothing on this side. So total of this comes to their capital account, and this is the capital account that will be shown in the balance sheet. The opening balance sheet, when we prepare the opening balance sheet, the opening balance sheet will feature these capitals now, what we just calculated with the updated assets. There was increase in machinery, furniture, stock was reduced, debtors, bank, creditors, unrecorded liability, provident fund, all the adjustments that we have taken care of in the revaluation account will be brought here and then will be stated in the opening balance sheet. Are we clear, girls? One little clarity that I'm making, why do we call this opening balance sheet? We make it at the end of the business. But why is it opening balance sheet? It was a question in the Viva which a girl could not answer. It is the opening balance sheet because we are closing this year and we will open with these balances now in the next financial year. So opening balance sheet of the next financial year will hold these assets, these values. So that is why it is called the opening balance sheet. Are we clear, girls? Okay, after this we switch to the next question. One more question for practice.